Okay, let's dive in. Welcome back to the deep dive. This week, we've been looking at sources from November 17th through the 24th, and it was a week defined by, well, a pretty unbelievable paradox.
It really was. Almost a contradiction in terms.
Yeah, you had the industry facing this absolutely devastating security breach on one side,
A huge one.
and at the exact same time achieving some of the biggest structural milestones in its entire history. It was whiplash.
It was. And I think when you synthesize all the sources, the big takeaway isn't that the market is just ignoring risk.
Right.
It's more that the conviction from institutions, the movement on regulation, the technical scaling, it's all just becoming more powerful than these immediate security problems.
So the foundation is getting stronger.
Exactly. The progress in efficiency and governance is starting to create this floor that even major exploits can't seem to break through anymore.
And that is exactly our mission for this deep dive. We want to look at why that market resilience held so firm for you, the listener. We're going to break down the top 10 stories from this week, and we've grouped them into 3 big pillars.
First, the institutional validation that's building market confidence.
Then the new guardrails being built, so security audits and regulation.
And finally, a really monumental win in the scalability war.
We're basically looking for the hard evidence that this space is finally truly maturing.
Ready to get into the data.
Let's start with market confidence, because this is where that paradox is just so clear. Bitcoin has been holding incredibly steady after that huge surge, consolidating right around the $120,000 level. Normally, after a big move like that, you'd expect a deep pullback, a kind of, wash out of the weak hands. But we just didn't see that.
And what's really fascinating here is who is supporting this price. The sources all confirm this resilience is not coming from, say, sustained retail hype or buying pressure. Instead, the on-chain data shows very heavy, very targeted accumulation by institutional whales.
So the big players.
The big players. And they're doing it on any minor dip below that $120,000 psychological mark.
So they're not speculators. These are long-term holders just using any small drop as a chance to buy more.
Precisely. They are treating $120,000 as the new bedrock. It confirms their long-term confidence in the asset class. It signals that big capital sees this price level as a sustainable entry point, which points to a belief in all the structural maturation we're about to talk about.
And that belief, it's not just theoretical, right? I mean, the biggest story this week confirming that institutional validation has to be JPMorgan Chase. They didn't just, talk about blockchain. They launched serious infrastructure.
This is the moment you really can't overstate. JPMorgan officially launched a fully functional private blockchain platform.
Private, that's key.
Very key. And it's dedicated solely to the trading and the seamless settlement of tokenized traditional securities for their institutional clients. Think of bonds, equities, funds, all running on blockchain rails that they control.
Okay, so when you say tokenized traditional securities, just for you at home who might not be deep in the jargon, what are we really talking about here?
We're talking about taking an asset that already exists in the traditional finance world, like a share in a money market fund or a piece of corporate debt.
Sure.
And you represent its ownership digitally as a token on their private ledger. The benefit, it's instant settlement. It's 24/7 trading. It's massive efficiency gains compared to the multi-day process you still have in legacy finance.
So this move by JPM is really proof positive that blockchain's efficiency is now seen as mandatory for established markets.
Yes. They are operationalizing the technology. They're moving way, way beyond the pilot stage.
And that shift from just talking about tokenizing assets to actually formalizing them as an asset class, we're seeing that elsewhere too. The real-world asset sector, RWA, it's moving from a niche crypto idea to a real financial category, and a lot of that is thanks to S&P Global.
That's a huge step for mainstream adoption. S&P Global unveiled a new index this week. And this index is designed specifically to track the performance and the governance tokens of the leading RWA tokenization platforms.
So why does an S&P index matter so much? What does that do?
Because S&P is the gold standard for benchmarks, period. When they create an index, they're giving institutional investors, pension funds, sovereign wealth funds, you name it, a standardized, formal way to measure performance and allocate capital to the sector.
It gives them a box to check.
Gives them a box to check and all the legitimacy that comes with it. It's the structure needed to make RWA investments commonplace, which again, validates blockchain as the underlying tech.
Now, shifting to global demand for a second, We saw all this fanfare around the Asian markets getting into Bitcoin and Ethereum ETFs, specifically in Hong Kong. The big question was that initial excitement just, pent-up demand, or is the interest actually sustained?
And our sources show it is clearly sustained. The Hong Kong spot Bitcoin and Ethereum ETFs maintained really strong and, what's more, remarkably stable daily trading volumes all rank.
So that initial $1.5 billion launch wasn't just a flash in the pan.
Not at all. It proves there's lasting interest and reliable demand from that whole Asian investor base. It really means the institutional floodgates are truly open worldwide, and they're not so easily closed by a bit of market chop or a bad news cycle.
Okay, so we've established that the institutional build-out is happening, and it's robust. Now we have to talk about the other side of that paradox, the massive negative headline that tried to overshadow it all. The security risks are still very, very real.
Yes, and the sophistication of this particular attack was chilling. The exploit of the CrossChain X bridge was highly complex, and it resulted in a devastating loss of about $350 million in user funds.
$350 million, that is a huge number. It's really hard to look past that. So why didn't the market panic? Why didn't all that accumulation we saw at 120K just stop cold?
That's the critical question, right?
Yeah.
The exploit was a stark, brutal reminder that security trade-offs are just inherent with cross-chain interoperability.
You're trying to connect different systems.
Exactly. Every new connection just expands the attack surface. It's an exponential problem. But the market, and especially institutional capital, is starting to treat these specific bridge failures as technology risk that's inherent to specific projects.
Not to the whole space.
Not as a systemic risk to the entire asset class. So instead of fleeing digital assets entirely, smart money is distinguishing between a flawed app and the fundamental viability of the underlying blockchains.
And crucially, the industry is building its own defenses at the same time.
Yeah. Yes, and the sources highlight a direct counter-narrative to the hack. For example, the developers of Aave announced the successful completion of the security audit for the core modules of the upcoming Aave V4 upgrade.
Why is that particular audit so important right now, especially coming right after a huge bridge exploit?
Because Aave V4 specifically focuses on improving cross-chain functionality and capital efficiency.
Ah, so it's directly related.
Directly. The fact that a major lending protocol is proactively putting its complex, interconnected system through intense, successful third-party audits immediately after a hack like this. It shows a real commitment to self-regulation and security hardening. It's really the only way you can earn back the trust lost from something like the CrossChain X hack.
And beyond that technical hardening, we're also seeing regulatory hardening, even if it's maybe slower than we'd like. We saw a landmark settlement from the US SEC this week with a DeFi protocol called Zenith Finance.
This is where we shift from technical guardrails to legal ones. The SEC settled with Zenith, and yes, a large fine was part of it, but the practical outcome is monumental for other protocols.
And what is that monumental outcome? What's the precedent that was set?
The settlement established a clear, though definitely restrictive, path for registering and structuring certain token functions.
For what kind of tokens specifically?
Specifically for DeFi governance tokens. For years, protocols have been in this gray area, not knowing if their governance tokens would suddenly be deemed unregistered securities. This settlement, it suggests a kind of foundational regulatory playbook.
So instead of the SEC just saying everything is illegal, this actually gives a potential roadmap for compliance. Can you just quickly clarify what kind of path or guardrails were established here?
The key was differentiating between how the token was initially sold, the fundraising part, and its ongoing function for governance. The settlement implicitly gave protocols a framework to register specific operational features, things like voting rights or fee structures, while potentially allowing the decentralized governance part to continue.
So it's not a blanket ban?
Not at all. And this clarity, even if it forces some painful restructuring and high compliance costs, it's absolutely indispensable for institutions. They need regulatory certainty before they can deploy massive amounts of capital. They just need to know the rules of the road.
Right, and those rules, those institutional platforms, they're all necessary. But they're completely meaningless if the underlying public networks can't handle the traffic. For mass adoption, the tech has to be cheap and fast and reliable. And the sources suggest we just hit a huge technical milestone this week in Ethereum scalability.
We did. We finally saw the promise and the scaling roadmap really come to life. The aggregate average transaction fees across all the major Ethereum Layer 2 networks, so you're talking Arbitrum, Optimism, Base, all of them, fell to their lowest average point in 18 months.
18 months. That is a huge viability marker. That confirms the network is actually ready for global scale.
It does.
But we have to ask why the fees drop now. This wasn't arbitrary. What was the specific technical breakthrough?
It is entirely technical. And the sources attribute this milestone directly to the successful implementation of key data availability improvements on the Layer 2 networks.
Okay, let's unpack that technical jargon for a second. When we talk about data availability, what exactly changed that suddenly makes everything so much cheaper?
So think of it this way. Layer 2s roll up thousands of transactions into one batch, and they post a snapshot of that data onto the main Ethereum chain to secure it. Previously, that data was really expensive to store on the main chain. The recent implementation, which is tied to the architecture from EIP-4844, it makes the space for this L2 data dramatically cheaper to access and verify.
So they have their own express lane now, basically.
It's like having a dedicated, low-cost pipeline just for posting their transaction evidence. This structural change is what's driving down the costs, and it validates the core architectural decisions that have been made over the last few years.
And that validation, it immediately translates into real utility for users. We can see the impact just by looking at the stablecoin market.
Absolutely. Stablecoins are the digital circulatory system for this whole economy. The reports are showing a major pivotal shift. The majority of new issuance for flagship stablecoins like USDC and USDT is now happening natively on Layer 2 networks.
Not on the Ethereum mainnet.
Not on the expensive Ethereum mainnet.
That is the sound of real adoption. It means the utility of the L2s, the near-instant speeds, the super low gas costs, has finally eclipsed the sort of perceived need to be on the main layer for daily use. If stablecoins are choosing L2s for new capital, then L2s are officially the economic hub.
And if you connect the scalability win to the bigger picture, it's all happening at the same time that governments are seriously exploring digital currencies. The UK Treasury made a key policy move this week regarding a potential digital pound.
They released a consultation paper. What was the focus there, beyond just saying they're still thinking about a CBDC?
Well, the paper focused heavily on implementation, design, and core principles. It outlines a proposed timeline and, critically, the core privacy frameworks for a potential central bank digital currency.
Privacy is always the big concern there.
It's the main hurdle. They're trying to find that balance between transactional efficiency and addressing the deep public concerns about, government surveillance. This kind of focused consultation shows serious forward momentum. The UK is getting much closer to a real decision on implementation.
So when we wrap this all up, what does it mean for the 7 days we tracked? You have the structural gains, JPMorgan's platform going live, the S&P RWA Index making a new asset class legitimate, the SEC providing a regulatory playbook, and the L2s finally proving they can scale. All of these things fundamentally outweighed the security setback of that $350 million exploit. The market didn't just survive the risk, it actually consolidated its confidence around all this demonstrable progress.
And that is the essential insight for you, the listener. The consolidation of Bitcoin at $120,000 is being backed up by sustainable, measurable achievements. You have the technical infrastructure proving you can handle the scale, and you have global regulatory bodies, from the SEC to the UK Treasury, moving the whole ecosystem towards legitimacy and usability for traditional finance.
So the foundations are being built at the same time from all sides.
From all sides simultaneously, which drastically reduces that perception of systemic risk.
It feels less like an industry that's just waiting for permission and more like one that's actively defining the next generation of finance.
I think so. You're seeing established finance validate the technology, engineers optimize the infrastructure, and regulators slowly define the rules all at the exact same moment. That kind of synergy is very difficult to disrupt.
Which brings us to a final provocative question for you, the listener, to really think about as you process all this. Given that major institutions like JPMorgan are busy building these powerful private tokenization rails, while S&P is formalizing RWA benchmarks and the UK is consulting on a sovereign digital pound, how quickly will real-world assets and state-backed digital currencies start interacting directly on these highly efficient and newly scaled Layer 2 rails?
That's the convergence point.
That's it. That point where private institutional assets meet public, scaled infrastructure, that's where the biggest innovations and disruptions are likely to happen, and maybe in the very near future.
An excellent point to reflect on. It connects all three pillars of progress. Thank you for joining us for this deep dive.
We'll catch you next time as we continue to track the irreversible integration of digital assets into the global financial structure.